Hi everyone, welcome to today's video. My name is Corey Stackhouse, and we're going to be discussing the top 7 retirement concerns and a few different ways on how you can combat those. Before we begin, I'm going to go over a little bit of disclosure. I am a financial advisor and an insurance agent. I do have a practice and I work with clients. Please make sure to discuss these concepts with your financial advisor, attorney, CPA, whomever it is that you discuss these concepts with to make sure it's going to be applicable to you. If you are in need of financial services, we are happy to help at Stack Enterprises. My contact information will be below in the link in the description. What are we going to accomplish in today's video? Well, we're going to discover the top 7 pre-retiree concerns. We're going to discuss solutions for those concerns, and we're going to provide you some overall insights for your future self to consider. The first concern for pre-retirees is going to be outliving your savings. So there's going to be a challenge to ensure steady retirement income, most may say. The uncertainty of the economic environment that you're in and increasing life expectancies are all a reason and valid reasons to be concerned about outliving your savings. So here are a few potential solutions for you. Solution number 1, diversifying your investments across various investment classes. Different comfort levels are going to require a different level of risk inside those investment portfolios, but in the short, the most important thing you can do is diversify your investments to ensure that those investment types are going to be suitable to provide you the future income that you need. Another big thing that you can consider would be, the second option would be annuities. I think when I started off my career almost 10 years ago, annuities used to be a really bad word. I think I've been untrained to that thought now because what they do, in short, are if you provide an insurance company a lump sum of money, they will ensure a guaranteed lifetime income, very, very similar to a pension. I know a lot of those none of us have anymore nowadays. So that is another alternative that can provide you future fixed income that you cannot outlive. So for example, just for hypothetical sake, if you gave an insurance company $100,000 and they said that they would give you $5,000 a year every year forever, you know that if you had that money in the savings account, that money is only going to last 20 years, if my math serves me well. In the event you give that to an insurance carrier and you live for, let's say, 25 years, that means you would have gotten paid out $125,000 on that investment. Again, you cannot outlive that money because that's a contract with an insurance carrier. So that's another very useful tool a lot of pre-retirees consider looking into, especially pre-retirement, because you can build up some guaranteed income streams in those if you let them cook for a while. The third thing you should be doing is you should be regularly reviewing and adjusting your withdrawal rates. So especially when you're in retirement, I know pre-retirees, some of us decide to dip in those investment accounts prior to being fully committed to retirement 100%. You should definitely be considering changing your future adjusted withdrawal rates based on the market and conditions that we have. If we have a really, really good year in the market, you can maybe justify taking some extra money out for an extra vacation or whatever it may be. In the event we have a really, really bearish market and the market goes red for us, those might be years that we consider looking at our needs versus our wants and taking those wants into consideration and maybe cutting back on them just a tiny smidge for a short period of time in hopes to not have to worry about outliving your savings for your future self. So regularly reviewing those adjusting those withdrawal rates is always going to be a suggestion of mine. A second big concern for pre-retirees is going to be future healthcare costs. The medical advancements and the cost associated with those are expected to go up over time, which is a concern, and the unpredictability of future health needs for yourself. So whether you're going to be unfortunately considering having cancer for yourself, or if you're going to need a long-term care facility or whatever it may be, those are all concerns that are on our minds. If we had the crystal ball to know exactly how this was going to play out, I would be out of a job because it would be way too easy, I guess we could say. But here are a couple solutions for you. First thing I would strongly suggest you do in order to combat the concern of rising healthcare costs for yourself in the future would be to take care of yourself. I know a lot of us take this for granted, but if you are working yourself to death and not taking care of your body as you are building up this retirement savings for your future self, and when you get there, all you have is a bunch of medical problems and are not able to enjoy the money that you've been saving your entire life, I think that is one of the most tragic things that can happen to a retiree. So I strongly encourage you maybe consider taking care of yourself even better than what you currently are. Always stay active. I'm a big advocate of the gym. I'll have to make a future video on that in the future, but I think it's a daily ritual that a lot of people should consider, myself. But the second thing that you could be doing is you could be also looking into health savings accounts. A lot of individuals don't know this, but those health savings accounts do not have to be spent every year. You can roll them over and you can invest those monies. And if you don't have any healthcare costs right now, that's a great problem. you can actually use this whenever you turn 65 and you need to pay for your Part B on your Medicare. That's going to run, I think in 2023, it's $164.90 a month. Well, if you've got a health savings account that's very healthy, that can help cover your out-of-pocket expenses you would have for Medicare when you turn 65. So that's a big one. And again, the investment inside of that account is a very, very powerful tool. I think it's better than an IRA and a Roth combined if we're only talking healthcare concerns. The third thing that you could be doing, or a way to combat the concern of healthcare costs, would be to consider looking at a long-term care insurance. I know it's not a fun thing to do. I tend to suggest people who are healthy and young and anywhere from 50 to 65, that's kind of your prime age to be strongly considering looking into these, because those policies could pay dividends for you in the future whenever you need to go to a long-term care facility or have some long-term care need help. I say that because I think there's a fun fact I heard the other day. 70% of 65 and up individuals will need some sort of long-term care in their lifetime. So if you've got husband and wife that both have a 70% likelihood of needing long-term care needs, there's a very good chance that at least one of you would. There's a lot of new long-term care policies out there now that you can incorporate life insurance if that's part of your estate goals, where you can borrow from your death benefit before you die, basically. You can purchase a standalone long-term care policy. Those are great. You can also buy annuities that would give you a double or tripler on the benefit of the annuity in the event you needed long-term care. So there's a lot of useful tools out there that I strongly suggest you ought to consider looking into, especially pre-retirement, so you can do that while you're young and healthy and able to be underwritten, because most insurance carriers will want to make sure you're healthy before they'll just sign you up for a long-term care policy. Another thing you ought to consider doing, especially if you are 65, would be looking at your Medicare options. I know each year there is an open enrollment period. At the time of this video, we've got a couple of weeks here before open enrollment starts back up. Look at your Medicare policies every year, whether you've got a Medicare prescription drug plan and a Medicare supplement plan, or if you have a Medicare Advantage plan. Each year, your prescription drugs alone can change drastically from person to person on what you're on and what your doctor prescribes to you. Different insurance carriers are going to offer different benefits on the drug plans especially. So I strongly suggest you look at those, because you don't want to sign yourself up for a plan where you're going to have extra out-of-pocket costs that you didn't ever anticipate just because you didn't do the service of doing some research on yourself or contacting a Medicare agent. We do that inside of our office as well for our clients, but contact anybody who does Medicare for you, or you can get in touch with Medicare.gov, and they'll have tools available to you for you to quote and or find the information you need to choose the suitable policy that's going to be right for you. So those are four different ways that you can combat the rising healthcare cost concerns. All right, the third biggest concern for pre-retirees is going to be inflation. So I'm sure we all know a gallon of gas 50 years ago was a lot cheaper than what it was today, for example. But the diminishing purchasing power of today's dollar is what I mean by inflation. The erosion of your savings and what it can actually obtain you, kind of the same side of the coin, if you will. And then how to maintain the lifestyle costs that you have, either pre-retirement or making sure that you're going to be able to keep a standard of living that has an increasing cost, because we all know things get more expensive. I'm sure you've all noticed since COVID, your grocery bills have gone up drastically. So that is something we expect to continue throughout your retirement years. So how are you going to combat not running out of money and making sure your purchasing power is going to increase over time as well? So here are a couple solutions for you. All right, the first solution for you would be to look at investment assets that have historically outpaced inflation. Now, I cannot say that investments' past performance ever predicts future performance, because I would be lying to you, but there are some notable assets that historically have outperformed inflation and provided returns to investors in these types of things. So that can include gold, it can include commodities, real estate, it can include real estate investment trust, stock and bond portfolios, S&P 500, the Bloomberg Aggregate Bond Index. You've got loans. A second thing that you can consider looking into would be Treasury inflation protected securities, or TIPS. In short, how they work is the principal value of the TIP is adjusted based on the inflation rate, ensuring that your principal itself and the interest rate on that tip is going to be increased proportionately. So you're not going to lose purchasing power on those types of investments. The third thing that you should be strongly considering doing is, again, regularly reviewing your investments and the strategies that you have inside of your financial plans. In the event we are in a very bearish time, you may have opportunities and investments that are going to bounce back better whenever the bulls come out, they say, or vice versa. In the event that you have some really big gains on certain investment types because we've been in a bull market, and we foresee maybe a bearish market in the future, adjusting your comfort level, adjusting your risk level inside of your account and the investment types inside of it that are going to maybe geared towards inflation protected assets are going to be another way that you can combat the concern of inflation. Basically holding the right types of investments at the right time. Fourth biggest pre-retiree concern is going to be market fluctuations. So I am certain that anybody who has had any investment experience at all has seen the roller coaster of how fast up and down investments go on a second by second basis every single day of the working week. So market fluctuations and the concerns are going to be reflected based on we want to know the potential impact of market downturns. We want to know the unpredictability of market behaviors and the risk of significant losses inside of a portfolio. So how can we combat those? Here are a few options for you. First thing you could do is you could diversify your assets. I think that's been an answer to multiple concerns inside of this. So I hope that it's taken home that having a good mix of diversified assets across different investment asset types are going to be a very good suggestion for you and your retirement income strategy. If you diversify across multiple asset types, how that's going to affect market fluctuation is you have certain assets that are going to be very high risk, so they might be high reward or high loss opportunity inside of them, and other asset types may have very low risk, maybe low reward and low loss opportunity. So how that's going to affect you is if you have a good mix of those investment asset types, that is going to make it to where your investment accounts are not going to be directly in line with what you see on the ticker symbol on the television, the stock market per se. Another thing you ought to consider doing is you ought to consider looking at maybe gearing your investments more conservatively as you get closer and closer to retirement. For example, I'm 31. In the event that I've lost everything that I've saved for my own retirement tomorrow and start over again, I've got lots of time to build that back up. Whereas somebody who is 6 months out from retirement has a 50% drop in their portfolio because they decided to leave it too risky. That is not something where they have 20 plus years to put together a portfolio back together for themselves. So shifting your assets to more conservative assets the closer you get to retirement is always a strong suggestion of mine. Another thing you ought to consider doing is periodically rebalancing your portfolio. So again, when market highs are happening, you might want to take some of your profits off the top, off of the risky stuff, and put it in the conservative stuff. Vice versa. In the event the market is down and your equities are down in value, but maybe your bonds are not, you might want to actually consider selling off a part of your bonds to go buy more equities because you're buying everything at a discount per se. If the stock market dips by 40% tomorrow, I know all my sideline money and bond money is super happy about that because they can go buy into the stock market at a 40% discount is a good analogy I guess I can give you. All right, the fifth concern for pre-retirees is going to be tax implications. So what I mean by that is the potential bite from tax savings in the future, the complexities of the tax code and regulations, and the challenge of optimizing which accounts you should be pulling from to minimize your overall taxes when you are retired. So here are a few solutions for that concern. My first suggestion, and one of my favorites, is you ought to consider leveraging a Roth IRA or a Roth 401k. How these work is you put after-tax money into them, you invest the money. As long as you're 59 and a half and you qualify for withdrawals on that account type, you get to take your money out tax-free plus the earnings inside of there. So that's very, very powerful. It also can be very, very powerful for anybody who is under the age of 65. I think I missed it on the slide earlier where if you're under the age of 65, you might ought to consider looking at your COBRA insurance and your ACA insurance and your short-term healthcare insurance. In the event that you decided to look at Obamacare, if you decide to retire prior to the age of 65 and a half, a Roth IRA can be leveraged because you can take money out of your Roth to subsidize your early years of retirement and make it look for taxation or taxable income sake like you make not very much. That can directly affect your health insurance premiums from age retirement to age 65. So fun fact, I made a couple other videos on it inside of my channel, so check it out. I'll try to think if I can post a link to this inside of this point in my video. No promises though. I'll leave a link in my description if I can. Now, the second thing that you ought to be considering doing is you ought to consider talking to a tax professional, whether it's a CFP like myself or a CPA or somebody that does taxes for a living. I always suggest talking with them to see if they are aware of any new tax laws or regulations that are going to directly affect you and your situation. Speaking of that, you want to make sure that you stay on top of those yourself because that's going to help you optimize which accounts you should be taking monies from. For example, that ACA analogy I gave a moment ago, or Obamacare, if a retiree shows that they only have Roth IRA distributions and they have no Social Security income, they may be able to find themselves a health insurance plan that could, after subsidy, be $0 a month. But that's case-by-case situation and your household income and so on and so forth. So talk to a healthcare professional or call my office if you don't have anybody to talk to about it so that you can get a better explanation for your unique situation. A sixth concern of pre-retirees is, what the heck am I going to do after I am done working, because all I ever do is work? So there is an emotional transition that happens whenever you begin retirement. There are sometimes a potential feeling of aimlessness or a loss. And a lot of people identify themselves with their career. So I feel as though, as a financial advisor, part of your job is the psychological state of helping people transition from accumulation phase to distribution phase with assets. But here are a couple solutions for yourself if you find yourself being concerned with finding purpose after work. First thing you ought to consider doing is look at what your extracurricular activities are. I heard something, forgive me, I don't have the source to cite it from, but I think 4 is a very magic number for your things you want to find passion in, or you want to find higher up on your priority list per se when you're in retirement. For example, there was a story of an individual who did nothing but, during his retirement years, he wanted to golf and he wanted to spend time with his family. That's great. There's nothing wrong with those two things, but golf is not a 12-month season for most individuals unless you want to travel all over, which you can build that into a retirement plan. Cool. But spending time with your family isn't necessarily something you're going to do 100% of the time during retirement either. So having other activities and or things you could do with your time, because you now have a lot more time than what you ever anticipated, you want to make sure you have activities that are going to be a good mix of physical, mental, and social aspects involved in them, so you can make sure that you're going to be having things to do throughout your retirement years. Another thing, looking into volunteering or community services. From personal experience, I know I've always get to feel good whenever I help anybody out for any reason whatsoever, but I know from other clients of mine that one of the most passionate things they do now is volunteer and give back to the community, because money isn't a matter for them anymore. It's what gives them meaning, and it's one way that they derive value from their time that they have on this planet. They want to give back. So that's one thing I strongly suggest you look into if you've never done it before. Another thing you can consider doing is you can consider working part-time. Again, there is a transition period from full-blown working full-time to retirement. Some people like to break that up and do part-time work for X number of years to not only supplement their income, but also give them a sense of purpose or meaning. You do have, if let's say you've worked in a factory for 35 years, you've got some expertise that a lot of people do not have. And if you had any way to monetize that, or to consult, or to give that information to somebody who could obtain value from that, that is one thing that I ought to consider, you ought to consider looking into for yourself as well. The seventh concern for pre-retirees is the estate planning piece. So how do I ensure that I leave a desired legacy for my loved ones? What are the potential legal complexities of an estate? And how do I avoid any family conflicts? So those are the biggest pieces of the estate planning concerns, and here are a couple solutions for you. First thing you ought to consider doing, if you don't already have a will set up or a trust set up, you ought to consider looking at it. I say that because most people that I meet with, if they have a will set up, they will have done that 5 or 10 years ago and never looked at it since. You are a new person from the day that you set up that will to whom you are now. I encourage, and there is no exact rule of thumb, but every 2 years is always a good target point to revisit your wills and your trust to make sure that they are in line with your wishes. That is going to help minimize any concerns that you have on the estate planning piece. Now, if you have a complex situation, I suggest you ought to consider discussing that with an attorney to see if it's going to be a good idea to maybe insure or set up a trust for your situation. This can be, what it does is it provides privacy for the family first off, but the second piece is it gives you control after you're no longer here. So you could set certain stipulations and requirements, and you can use it for taking money out of your estate if you happen to be worth more than 26 million as a family unit of husband and wife in the year of 2023. There are ways that you can use trust to get money out of your estate, so you can minimize the taxes that the family would have to pay upon inheriting your trust as well. The third thing that you ought to consider doing is you ought to consider an open family dialogue. It blows my mind that we live in a world that we are not comfortable talking about the finances with the ones we love around us. That That blows my mind. The reason why is because there is an ignorance tax that we all have paid to accumulate the wealth that we have, for the most of us, unless we inherit it. So let's assume a family buys a $5 million life insurance policy that's going to pay out as a permanent one for their one and only child, who currently is 45, 50 years old and does not have any wealth accumulated for themselves or any experience in managing a significant amount of money. It's a great gift that they have the opportunity to receive that death benefit from you as the family member, but at the end of the day, they don't have any experience managing $5 million. So I think it would be doing them a disservice by not at least giving them some sort of inclination of, hey, there is something coming. Let's talk about money a little bit. Let's talk about what I would desire with my estate after I'm gone. I just think an open family dialogue is going to eliminate any family matters that may come up from anybody arguing about, oh, this is what mom or dad wanted or didn't want or whatever it may be. If everybody's already aware prior to you dying, it makes things a lot simpler, especially from my own experience with working with families on these types of topics. So I hope that is useful on this estate planning concern. In conclusion, I have a slide here with a lot of information. The short version is we have covered everything from outliving one's money to estate planning, healthcare costs, and everything in between as the big concerns for pre-retirees, especially when we're talking about retirement income. The one suggestion I would tell you to take away from this video, do some planning for yourself. Whether you talk to a financial advisor or you go online and find some planning tools or just educate yourself on the topic. Education is power, in my opinion. So the more that you have, the more informed decision, the more equipped you are going to be to make better informed decisions for your future self and your current self. So envisioning your future self in the place that you want it to be is also going to provide you a little bit of extra motivation. So if you want to be the person that goes and sits on the beach and drinks cocktails once a week or twice a week or every day of the week, that's great. I always challenge you to consider what are the other alternatives and the other things you want to do with your future retirement as well, because that is going to be, for most of us, about a third of our life. So make sure that you're doing your planning appropriately and don't wait until the last minute to start thinking about these things, because there is a lot. Time is your biggest weapon. So please make sure that you consider looking into these things sooner versus later, whether you call my office and talk to me or find your own advisor, whomever it may be. Talk to somebody about it, educate yourself, make sure you're going to be positioning yourself the best way that you can for your future situation so you don't have any of these concerns to worry about. I hope you found value in this video today. For my last slide, again, contact the local advisor. If you would like to stay more informed, I do post educational content on these topics, whether it's going to be retirement planning, investment management, Medicare, home and auto insurance, life insurance, annuities, the whole 9 yards. I do that at least once a week. I think I'm going to bump it up here to probably a couple times a week. We'll see. No promises, but in the event you guys derive value from this video, please consider liking it and sharing it with friends or family who could benefit from the information that was described in here. I also would love it if you would consider checking out my website. I've got a little bit more information on there if you want to dive in further. I'll have all my information in the description of this video. So I hope you have a great day and thank you for your time.